Imagine hiring a plumber, right, to fix your sink.
Okay.
He finishes the job in an hour, which is great. But then, before he leaves, he hands you this legally binding contract, forcing you to pay for 10 years of hypothetical future maintenance. Upfront, entirely in cash.
Oh, wow.
Right. And if you don't pay it, you literally don't get your house back. You would obviously call the police. But if you're a multi-billion-dollar private equity firm, you just call it, standard operating procedure.
Yeah, you call it an accelerated monitoring fee, and you just buried it on page 400 of some dense partnership agreement.
Welcome to the deep dive. Today, we're looking at the absolute hidden mechanics of capital. Because when we think about markets, we usually think about gravity.
Right, like natural gravity.
Exactly. Capital flowing naturally to the best ideas. Just decentralized, fluid, finding the path of least resistance. But that is not what's actually happening in the modern financial system.
No, not at all.
The sources we're pulling from today, they point to a very different kind of physics. They call it the thermodynamics of capital. What we're really dealing with is artificial containment.
Which is such a fascinating term.
It really is. It's capital being locked up, highly concentrated, and just strictly controlled by insiders who have engineered the plumbing, literally engineered it, to ensure they get paid at every single step, long before you, the public investor, ever see a single dime.
Yeah, and we're pulling from an incredibly revealing stack of documents to unpack all this today. I mean, we've got an abstract framework detailing this whole thermodynamics of capital idea.
It's dense, but really eye-opening.
Super eye-opening. Plus, we've got a massive Harvard law study on how IPOs are actually governed. We have the SEC's specific guidelines on the JOBS Act, some leaks-level legal memos from Dwayne Morris regarding private equity fee structures.
The Dwayne Morris stuff is wild.
It really is. And to top it off, internal investment banking perspectives from Parallax's Capital and Solomon Partners. Our goal today is to take all of this dense financial structuring and, translate it.
Right. So you, listening, can actually look past the flashy headlines of the next big tech IPO and see who is actually holding the power.
Exactly.
Okay, so let's unpack this concept of artificial containment, because we have to start with where the money is currently stuck. Capital isn't just concentrated right now. It is severely backed up.
Oh, it's a massive bottleneck.
We are looking at a private equity liquidity crisis that is, frankly, just hard to wrap your head around.
The scale is completely unprecedented. If you look at the recent ICR data, the private equity industry is sitting on its biggest exit backlog since 2005.
Since 2005.
Yeah. We're talking about 29,000 individual portfolio companies that are just currently trapped inside private equity portfolios. And the total enterprise value of those companies, it's roughly $3.6 trillion.
Okay, wait. $3.6 trillion.
Trillion with a T.
I mean, that is literally the GDP of a major industrialized nation, completely locked up in private hands. And I mean, these aren't fresh acquisitions either, right? They haven't just been on some recent buying spree.
No, quite the opposite, actually. 61% of these 29,000 companies have been held for over 4 years.
Wow.
And the average hold time has crept up to a record 6.7 years, which is a full year longer than the historical average.
So they're holding these companies much longer than they used to.
Exactly. And the real pressure cooker here is the ratio of what they call dry powder, which is basically unspent capital sitting on the sidelines relative to that trapped capital.
Right.
That ratio has plummeted to a record low of 35%. Just for context, 2 decades ago, that ratio was over 90%.
Okay, let's unpack this a bit more. Because the money is stuck. It's essentially a massive financial traffic jam on a highway, but there are no off-ramps.
That's a perfect analogy.
But wait, if I'm a major institutional investor, right, say I'm a pension fund or a university endowment, and I gave a private equity firm my money, I signed up for, what, a 10 to 12-year fund life cycle?
Typically, yeah. 10 to 12 years.
So if they're holding these portfolio companies for nearly 7 years on average, how does the math even work? How do these firms actually get their money out before the investors just completely revolt it?
If we connect this to the bigger picture, it really comes down to a ticking clock. And that clock is called the internal rate of return, or IRR.
Which is basically how they measure their success, right?
Exactly. But because IRR is a time-sensitive metric, every single day you hold an asset, your return profile degrades.
Ah, so the longer you hold it, the lower the official return looks on paper.
Right. The hurdle just gets higher and higher. So these firms are completely desperate for escape routes. Now, the traditional route is a clean sale. You sell to a strategic buyer, maybe a big tech company or a competitor.
Which is the easier way to exit.
Usually, yeah. Cleanest way. But high interest rates and massive regulatory scrutiny have made those buyers incredibly hesitant lately.
So a clean sale is kind of off the table for a lot of these. What's the panic button?
The panic button is something called a dividend recapitalization.
Okay, a dividend recap. Walk us through that.
So the private equity firm forces their captive portfolio company to take on a massive new loan from a bank.
Okay.
And then they use that newly borrowed cash to pay themselves a special dividend.
Wait, they take out a loan just to pay themselves.
Exactly. A famous example from the sources is KKR's takeover of Capsugo back in 2013. So KKR executed a dividend recap. They pulled $500 million in cash out of the company to pay themselves and their investors.
$500 million.
Right. But they retain 100% ownership of the business. So the private equity firm gets their liquidity, they get paid, but the underlying company is suddenly staggering under $500 million of new dangerous debt.
I mean, that just seems entirely unsustainable. You can't just keep levering up these companies to pay yourself without the whole thing eventually collapsing, right?
No, you really can't. It's a stopgap.
So they have to find a way to dump these assets into a more liquid environment. Like, they need the natural gravity of the public markets.
They absolutely need an initial public offering, an IPO. But historically, going public was this brutal gauntlet. You were subjecting your company to intense SEC scrutiny. They demanded complete transparency, and there were incredibly heavy compliance costs. It was the ultimate friction point for capital.
Which means if you're a private equity firm sitting on a massive, aging portfolio company, you might be terrified of that kind of public scrutiny.
You'd be very hesitant, yeah.
So you need a loophole. And ironically, the government literally handed them one on a silver platter back in 2012 with the JOBS Act.
The Jumpstart Our Business Startups Act.
Yeah, which, by the way, was wildly bipartisan.
It really was. And what it did was create an entirely new regulatory classification called the Emerging Growth Company, or EGC.
And what's the cutoff to be an EGC?
The threshold is having less than $1.235 billion in annual revenue, which covers a lot of companies.
Yeah, over $1 billion in revenue is not exactly a small startup.
Right. And if you fall under that line, the SEC essentially builds you this 5-year private on-ramp to the public markets. It totally bypasses the traditional regulatory toll booths.
I was looking at these exemptions from the SEC guidelines, and they are wild. I mean, normally an IPO requires 3 years of rigorously audited financials.
Under the JJBS Act, EGCs only need to show 2.
2 years.
Yeah.
And they get completely exempt from Sarbanes-Oxley Section 404B, right?
Yes, which is huge. That's the incredibly expensive rule that forces an independent auditor to actually verify that your internal financial controls work. They don't have to do that. They don't even have to fully disclose how much they are paying their top executive.
That's crazy. But the part that really stood out to me is the initiation process, like how they actually start the IPO.
Oh, yeah, the most transformative part. These companies are allowed to test the waters.
Test the waters.
Right. So they can hold these closed-door meetings with massive institutional buyers to gauge interest. And then they can file their S-1 registration statement confidentially with the SEC.
Okay, this is the secret practice test analogy. It's literally like letting a student take a massive career-defining final exam in a locked room.
Exactly.
If they pass and the market likes the valuation, great, they go public. But if the institutional buyers look at the books and balk, the company can just quietly pull the paperwork, and you, the everyday investor, never even know they failed.
It fundamentally shifts the risk, right?
Yeah.
From the insider directly to the retail investor. The stated goal of the JOBS Act was to remove the friction of capital formation, to get more companies to go public.
And it worked.
It absolutely worked. But here's the thing. By altering public visibility and delaying transparency, insiders get the liquidity of the public exchange, while the everyday investor is buying into a company with fewer audited financials and completely unverified internal controls. And on top of that, Wall Street analysts can even publish glowing research reports immediately after the IPO now, because the old FINRA blackout rules were scrapped for these EGCs.
Right. Okay, but here's where it gets really interesting to me. Let's say I'm an everyday retail investor. I buy into this newly public JOBS Act company. Sure, I have less financial data up front, but I own the stock now.
You're an owner.
Right. I have voting rights. I'm finally inside the restaurant, so to speak. I can walk into the kitchen and hold management accountable. That's how public companies work, right?
Well, you would think so. But the transition to the public market is heavily engineered. They use the public's money for liquidity, obviously, but they meticulously construct their corporate governance to ensure the public never actually touches the steering wheel.
The illusion of democracy.
Exactly.
And this brings us to that Harvard Law Forum study on corporate governance, because they looked at the 50 biggest U.S. IPOs, right? Huge deals, ranging up to $18 billion.
Massive companies.
And the data completely shatters this illusion. These newly public companies are essentially built like medieval fortresses.
Let's break down the mechanics of that fortress because it's pretty shocking. If you look at the seasoned S&P 500 companies, about 39% of them have what is called a classified or staggered board of directors.
Okay, 39%.
But in these massive new IPOs, 78% have them.
78%. Okay, let's explain how a staggered board actually neutralizes a regular shareholder. Because if I own the majority of a company, I should just be able to fire the board if they're performing terribly, right?
With a staggered board, you mathematically can't. So let's say there are 9 board seats. Instead of all 9 coming up for election every single year, they're divided into 3 classes.
Okay.
So you only get to vote on 3 seats per year.
Oh, I see.
Yeah. So even if the public shareholders universally despise the management, they would have to wage these multi-million-dollar proxy fights for 2 or 3 consecutive years just to win a majority of the seats. It makes replacing management or executing a hostile takeover nearly impossible.
And even the voting itself is kind of rigged in their favor. The Harvard study noted that 94% of these IPO companies use a plurality voting standard for directors.
Right.
Whereas the vast majority of older S&P 500 companies use a majority standard.
That distinction is huge.
Because if you run unopposed in a plurality system, you literally only need a single vote to win your seat. You could have 1 million shareholders withhold their votes in protest, and it wouldn't matter at all.
Not one bit.
Yep.
And the ultimate defense mechanism that the study highlighted is something called blank check preferred stock.
Oh, this one is crazy.
49 out of the 50 IPOs authorize this. It literally gives the board the power to invent a new class of stock out of thin air, attach super voting rights to it, and issue it to a friendly third party entirely to block an activist investor.
And they can do all of this without asking the public shareholders for permission.
0 permission needed. 7 of these companies even added exclusive Delaware forum provisions, meaning if shareholders do get fed up and want to sue for mismanagement, they are forced to litigate in a highly specific, very corporate-friendly court in Delaware.
Wait, hold on. If these structures are this blatantly hostile to the people actually providing the capital, the public, why does the market tolerate it? I thought institutional investors had proxy advisory firms that, graded corporate governance and told them to vote against this kind of stuff.
Well, what's fascinating here is the double standard. Proxy advisory firms essentially grant these newly public IPOs a grace period.
A grace period.
Yeah. They tolerate founder-friendly, highly protective structures in young companies, structures that they would actively penalize an older S&P 500 company for having. So the harsh reality of modern finance is that going public has really been decoupled from becoming democratic.
Wow.
When you buy that shiny new tech IPO, you are buying the economic risk of the shares. You are absolutely not buying a meaningful voice in the boardroom.
Okay, so we've tracked the capital so far. It gets stuck in a private equity bottleneck. The insiders use the JOBS Act to slip into the public markets without full transparency.
Right.
Then they build a fortress board with staggered terms and blank check stock so you can never fire them. But let's say the company's stock just trades sideways for a decade. The growth stalls out entirely. How do the insiders guarantee they still get rich while the public shareholders just flatline?
Because the extraction of value doesn't rely solely on stock price appreciation. They build hidden financial plumbing deep within the original partnership agreements.
Yeah.
And this is where we have to look at the legal memos from Dwayne Morris regarding private equity fund fees.
Most people probably know the classic private equity model, right? 2 and 20.
Right, the standard fee.
A 2% management fee on the total assets and 20% carried interest, meaning they take a fifth of the profits. That sounds straightforward enough.
It sounds straightforward, but that is really just the public-facing facade. Underneath the 2 and 20, private equity firms charge a dizzying array of transaction fees directly to the portfolio companies themselves.
Like what kind of fees?
Advisory fees, director fees, breakup fees. Now, the Institutional Limited Partners Association, the group representing the actual investors, they beg these firms to let those extra fees offset the standard 2% management fee.
So they aren't paying twice.
Exactly. But the Dwayne Morris memo makes it super clear that PE firms fight tooth and nail to double dip.
And the SEC has actually been running what they call presence exams, specifically targeting these hidden fees. And they're finding rampant abuses.
Rampant.
They uncovered these things called zombie funds.
Oh, the zombie funds.
Yeah, these are funds that have completely passed their expected lifespan. The assets are stagnant. But instead of selling the companies and returning whatever capital is left to the investors, the managers artificially extend the life of the fund for years. Why? Just so they can continue siphoning out annual monitoring fees from these dying companies.
But the mechanism that truly shows the audacity of the plumbing is the accelerated monitoring fee.
Yes. Okay, this is the plumber analogy from the beginning of the show, and it absolutely blew my mind. Walk us through how this is even remotely legal.
So, when a private equity firm acquires a company, they force that captive company to sign a long-term monitoring contract, right? Often spanning 10 or 12 years.
Okay.
The company agrees to pay the private equity firm a massive annual fee for vague, advisory services.
Right, consulting, basically.
Yeah. Now, let's say 3 years later, the private equity firm decides to take that company public in an IPO.
Right, so the monitoring contract should end, because the private equity firm is essentially cashing out and leaving.
It doesn't end. A clause in that contract allows the private equity firm to accelerate the remaining 7 years of hypothetical future fees, bundle them all together, and pay themselves a massive lump sum in cash directly out of the IPO proceeds.
Unbelievable.
They're legally billing the company for 7 years of advice they will literally never provide.
But how does an army of lawyers representing the limited partners, we're talking pension funds, university endowments, how do they miss this? How is this not considered fraud?
Well, because of the asymmetry of information and just the sheer density of the paperwork, these clauses are buried in the gray areas of limited partnership agreements that run hundreds of pages long.
And no one reads page 400.
Exactly. When the LPs sign the initial paperwork, the timing of any future IPO is entirely unknown. So the acceleration clause seems like this really distant, hypothetical legal mechanism.
Like it'll never actually happen.
Right. The real disclosure of the massive cash payout only happens years later when the acceleration is actually triggered. And by then, the private equity firm has the explicit contractual right to the money. It perfectly illustrates how insiders structurally ensure they get paid first, regardless of the asset's actual performance.
Okay, so the insiders hit the panic button, they IPO with the JOBS Act loopholes, they install a fortress board, and they take a massive accelerated fee payout in cash on the way out the door. The company is now officially public. The private equity guys are finally done extracting value from the public balance sheet, right? Please tell me they are done.
Absolutely not.
Oh, come on.
Even after the IPO is complete, the pre-IPO insiders have one final, incredibly esoteric piece of plumbing designed to siphon cash directly out of the public company for decades.
Decades.
Decades. It is called the Tax Receivable Agreement, or TRA.
Okay, let's bring in the sources from Parallax's Capital and Solomon Partners here, because this is like the ultimate insider secret. To understand a TRA, we first have to understand how these companies actually go public. Many of them use what is called an Up-C IPO structure.
Let's break that down simply. So before the IPO, the private company is usually structured as a partnership, right?
Okay.
When it goes public, it converts into a standard C corporation. When that legal conversion happens, the tax code allows for a step up in the tax basis of the company's assets.
Okay, so in plain English, a step up just means the company gets to claim its assets are suddenly worth a lot more on paper than they were yesterday, right?
Exactly. And because the assets are valued higher, the new public company gets to claim massive future depreciation and amortization tax deductions.
Ah, I see.
It effectively shields the public company's future income from the IOS. So it's an incredibly valuable asset sitting right on the balance sheet.
So the public company gets a massive tax break, which is great for the public shareholders, right? Less taxes, more profit.
Except the public shareholders don't get to keep it.
Of course they don't.
Before the IPO happens, the founders and the private equity insiders draft a tax receivable agreement. This contract legally requires the newly public company to hand over 85% of those actual cash tax savings directly back to the pre-IPO insiders.
85%.
85% paid out as they are realized over the next 15 years. The public company only keeps 15% of the benefit.
Let me just do the math on that conceptually. It's like the founders sell you their house, but before they hand over the keys, they hide a clause in the deed requiring you to forward them 85% of your property tax refunds for the next 15 years.
That is exactly what it is.
And the craziest part to me is the conflict of interest. Because the pre-IPO owners who are receiving these massive cash payments from the TRA are often the exact same people sitting in the C-suite making decisions for the public company.
Oh, entirely.
They are personally draining cash from the corporate treasury they are supposed to be protecting.
It's wild. And it also acts as a corporate poison pill. These TRAs often have acceleration clauses of their own.
Another acceleration clause.
Yeah. If another company wants to acquire this public company, the entire future value of the TRA, which could potentially be hundreds of millions of dollars, becomes due immediately to the insiders.
Wow.
A buyer has to pay off the founder's tax scheme before they can even touch the underlying business.
So what does this all mean? If this structure is so incredibly toxic to the public balance sheet, why do institutional buyers ever agree to it?
Well, this raises an important question about how capital monetizes inefficiency. From the insider's perspective, they argue, hey, we created that tax asset when we converted the company, so we deserve the cash. But the public market hates the liability hanging over the company. So now, boards of directors are actually forming special, supposedly unbiased committees to execute what are called clear day buybacks.
Clear day buybacks, what is that?
They try to negotiate with the founders to buy back the TRA liability at a discount and just clean up the balance sheet.
And this is where the investment banks from our sources, like Parallax's, step in, because they have actually turned these bizarre tax contracts into a tradable asset class.
Precisely. A specialized secondary market buyer will come in and value the TRA using a discounted cash flow model. Usually they calculate the company's weighted average cost of capital, or WACC, and then add a premium.
So it's heavily modeled out.
Oh, highly technical. The public company then pays a lump sum to buy out the liability. Their earnings per share instantly go up, the founders get their cash up front, and the secondary buyer gets a nice yield over time.
So the insiders created the mess, the public company pays to clean it up, and Wall Street takes a cut for facilitating the transaction.
You nailed it.
Okay, let's just step back and look at this incredible journey of capital we've just tracked today. We started with $3.6 trillion trapped in a private equity bottleneck, the ultimate artificial containment.
Right.
To escape the pressure, the insiders used the JOBS Act to slip into the public markets, completely bypassing strict audits and hiding their early failures.
Yep.
Once they're public, they maintain that containment by building fortress boards with staggered terms and blank check stock, ensuring you can never vote them out.
Exactly.
And all the while, they install this hidden plumbing, accelerated monitoring fees that charge for hypothetical futures, and tax receivable agreements that siphon off 85% of the public company's tax savings. All just to guarantee that the insiders always get paid first.
It is a breathtaking feat of financial engineering, and it's designed entirely to separate the economic risk from the actual control.
So for you listening, the next time you see a headline about a massive IPO, a hot new tech unicorn finally going public, or some big private equity buyout, you now know to look right past the ticker symbol. To look past the hype and ask the real questions. Who has the classified board? Who triggered the accelerated monitoring fees? And who is holding the TRA?
Absolutely. And, if we step back from all the mechanics, it leaves us with a profound, almost philosophical question to consider.
What's that?
Well, the public stock markets were originally conceived to democratize wealth, right? To distribute ownership of great companies to the everyday person. But if private actors have now perfected the thermodynamics of locking up control, bypassing transparency, and siphoning off the value through hidden plumbing before the public ever sees a return, are the public markets ceasing to be a place of shared ownership and instead just becoming a utility machine engineered solely to provide exit liquidity for private insiders?